the Monetary Policy Committee decided to lower the central bank rate by 25 basis points to 9.5% from 9.75%. The committee observed that the overall inflation is expected to remain below the midpoint of the target range in the near term, and this will be supported by lower food inflation, stability in energy prices, and the continued exchange rate stability. They also observed that central banks in the major economies have continued to lower interest rates, but at a more cautious and uneven pace depending on inflation and growth outlooks. The average lending rates in the domestic market have continued to decline, while private sector credit growth has continued to improve, although the pace has been less than desirable. The committee therefore concluded that there was scope for a further easing of the monetary policy stance to augment the previous policy actions aimed at stimulating lending by banks to the private sector and supporting economic activity, while ensuring that inflationary expectations remain firmly anchored and that the exchange rate remains stable. The MPC will closely monitor the impact of this policy decision, as well as developments in the global and domestic economies, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in October of 2025. In reaching its decision, the committee looked at global economic developments and the outlook. And they noted that despite the higher tariffs, the global inflation is expected to decline, supported by lower prices of energy commodities, mainly reflecting increased oil production by OPEC Plus and non-OPEC Plus producers, as well as subdued global demand. And as a result, the WEO, the World Economic Outlook projections by the IMF, project a deceleration of global inflation from 5.6% to 4.2% this year, and a further deceleration to 3.6%. And with this deceleration in inflation, the pace of monetary policy easing by central banks in major economies is expected to be more cautious and uneven depending on inflation and growth outlooks. In regard to international oil prices, these have moderated due to increased production and subdued global demand, but have remained volatile due to elevated global uncertainties. Oil prices increased in June of 2025 due to escalation of the conflict in the Middle East, but have since receded, reflecting increased production by the OPEC Plus and non-OPEC producers and reduced global demand. Major oil-producing nations of the OPEC Plus have agreed to increase their total crude production by 548,000 barrels per day from September 2025 as they continue to unwind the previous voluntary supply cuts. The main risks to oil prices relate to higher tariffs, which could have an impact on global energy demand, and also supply disruptions from escalation of geopolitical tensions, particularly the conflict in the Middle East. Turning to food inflation, food inflation has increased, largely driven by elevated edible oil price inflation, but cereals and sugar prices inflation have remained low. So global food inflation is projected to increase, or has increased, from 5.8% in June of 2025 to 7.6% in July of 2025. And the main reason for that is the sharp increase in inflation of edible oils, which has to a certain extent been offset by the reduction in prices of sugar prices, where inflation of the sugar was negative 13.5 in July. Looking at inflation in selected economies, the headline inflation in advanced economies has increased, partly due to stickiness in core inflation rates on account of persistent services price inflation. The U.S. headline inflation held steady in July of 2025 due to lower fuel prices, but core inflation rose faster than was expected. The UK inflation rose in June of 2025 on account of higher food and energy prices, while Eurozone inflation is on target at 2%. China's inflation remained low, mainly due to weak domestic demand. Turning to the global economic growth outlook, the effective tariff rate for the US eased to 17.3% from 24.4% in April, while that for the rest of the world eased to 3.5% from 4.1%, and the US had reached trade agreements with several countries. So global growth is expected to decelerate from 3.3% in 2024 to 3% and then to 3.1% in 2026. The revisions were upward for 2025 by 0.2 percentage points, and for 2026 was 0.1%. And again, these revisions reflected the revision to growth in the United States and China due to the lower effective tariff rates in trade, and also due to improved global financial conditions. The improved growth prospects for the US, for the Euro area, the UK and Saudi Arabia could boost demand for Kenya's exports, diaspora remittances, inflows, and also tourist arrivals. Kenya's growth is expected to remain above the global, the emerging market and developing economies, and sub-Saharan Africa averages, mainly reflecting the resilience and diversified nature of our economy. In regard to the global financial conditions, these have improved as reflected in the recovery of equity markets on the left-hand side, and also the decline in sovereign spreads for emerging markets and developing economies, including for Kenya. So to summarize the global developments and outlook, the global inflation is projected to decline in 2025 as well as in 2026, and this will be mainly driven by lower energy prices and also reduced global demand. The central banks in the major economies have continued to lower their interest rates, but at a more cautious and uneven pace depending on inflation and growth outlooks. The global growth outlook for 2025 and also for 2026 have been revised upwards, mainly reflecting the lower effective tariff rates on trade and the improved global financial conditions. Risks to the global growth outlook remain elevated, largely due to uncertainties surrounding trade policies and tariffs, weak global demand, and heightened geopolitical tensions in the Middle East, as well as the Russia-Ukraine conflict. Kenya's real GDP growth is expected to remain above the global, the sub-Saharan Africa and emerging market and developing economies averages, both in 2025 and in 2026. Turning now to the domestic macroeconomic developments and outlook, the overall inflation remained below the midpoint of the target range of 5 plus or minus 2.5% in July of 2025, but increase mainly on account of higher non-core inflation. So inflation, the overall inflation was steady between May and June at 3.8%, but in July rose to 4.1%, and this was largely due to the increase in non-core inflation from 6.2% to 7.2%, whereas core inflation only increased from 3.0% to 3.1%. And as a result, the contribution to overall inflation for core inflation remained unchanged at 2.2%, which was the same in June, but the contribution of non-core inflation rose from 1.6 percentage points in June to 1.9 percentage points in July. Looking at the drivers of core inflation, which increased in July 2025, this was mainly on account of higher prices of processed food items, particularly of sugar and maize flour. And you can see there in July, we have an increase in the processed food items. The contribution has increased from 1.1% to 1.2%, which pretty much explains the increase in core inflation from 3% to 3.1%. In regard to the drivers of non-core inflation, which rose in July 2025, and this mainly reflected an increase in energy prices. The three components of the non-core inflation is food, energy, and transport. Food inflation remained pretty much unchanged, but energy, the contribution of energy to non-core inflation, as you can see, between June and July. In July, it was negative 0.6, and then in July, it actually moved from a negative to a positive 0.3 percentage points, and this largely explained the increase in non-core inflation. And when you break down the elements in the energy, you see that what really pushed the energy inflation up was the electricity, which moved from actually a negative 3.4 to a positive 2.2%. And similarly, for the oil sector, for the energy sector, the pump prices, which had declined by 7.5% in June, only declined by about 1.7% in July. And therefore, one can clearly see that the increase in non-core inflation from 6.2% to 7.2% was largely because of increase in energy prices. Our forecast for overall inflation into the near term, we see inflation rising steadily, but mainly owing to seasonal factors, and then reaches 5.2. But by the end of June of 2026, we expect overall inflation to be firmly back below the 5% midpoint of our target range. In terms of expectations from the private sector, the MPC Market Perception Survey and the Agricultural Sector Survey show that inflation expectations remain firmly anchored within the 5 plus or minus 2.5% target range in the near term. With regard to the Agricultural Sector Survey, a majority of respondents to the July 2025 Agricultural Survey expect the prices of most food items to decline in the near term due to favorable weather and the onset of the harvest season for key crops, particularly maize. Nevertheless, respondents expect higher international prices of some processed foods and higher domestic prices of sugar to exert moderate upward pressure on overall inflation. In terms of the market perception survey for the banks and the non-banks, this survey showed that inflation expectations for both banks and non-banks in the near term remains anchored within the target range on account of the expected stability in food inflation and global oil prices, as well as the stable exchange rate. So to summarize developments and outlook for inflation, the overall inflation at 4.1% in July of 2025 remained below the midpoint of 5% of our target range. Second, the overall inflation is expected to remain below the midpoint of the target range in the near term. This will be supported by lower food inflation, stable energy prices, and the continued stability of the exchange rate. The 2025 MPC Market Perceptions Survey, as well as the Agricultural Sector Survey, show that inflation expectations in the near term remain anchored within our target range. And finally, the main risks to the inflation outlook relate to inflationary impact of higher tariffs on trade, elevated geopolitical risks, uncertainty in the evolution of international oil prices, and higher international prices of key processed foods. Turning to the domestic economic growth, the growth of the economy is expected to pick up in 2025 and in 2026, and this will be supported by continued resilience of key service sectors, agriculture, as well as the recovery of the industrial sector. The agricultural sector is expected to be supported by favorable weather conditions and the government's interventions such as the subsidized fertilizer. The services sector is expected to remain robust, leveraging on the digital economic transformation, and the recovery in private sector credit growth, which I will see shortly, is expected to boost activity in key sectors. And then finally, exports are expected to be supported by trade initiatives and bilateral agreements, including Kenya and China, the Kenya-EU Economic Partnership Agreement, and export promotion measures. So specifically, we expect agriculture growth to accelerate from 4.6% in 2024 to about 5.2% this year, and to remain at a high level of around 4.9 in 2026. In regard to the industry sector, we do see an acceleration in growth from 0.8 in 2024. We're expecting a recovery to 3.3 this year, and a further recovery to 3.7% in 2026. And this recovery will be underpinned by better performance in the mining and quarrying sector. The manufacturing sector is expected to do slightly better this year than last year, and to do also slightly better in 2026 at 3.3 compared to the 2.9% in 2025. And finally, with regard to the industrial sector, the construction sector is expected to recover. Last year, it only actually contracted by minus 0.7. So far, in the first quarter of this year, it grew by 3%, and for the year as a whole, we expect a recovery to 4% and a further increase in value addition of 4.9% in 2026. The services sector should continue to remain resilient, and we do expect for the year as a whole for the services, combined services, to grow by 5.7 and a further 6.2% in 2026. I think just to add, with regard to the construction sector and also the services sector, that we do expect the lower lending rates by commercial banks to contribute to the growth of those sectors. And in addition, the improved government spending on development spending in 2025 compared to 2024, we do expect that will have a positive impact on value addition in the construction sector. And we also take note of the government addressing the pending bills in the road sector and also in other sectors, and that also should contribute to increased value addition in the construction sector as contractors go back to work. Again, looking at the developments in the credit to the private sector for some of the sectors, we see manufacturing, the turnaround in credit of banks to the manufacturing sector from a low of minus 14.3, it has increased to 2.4% in July of 2025. Of course, as we saw just a slide ago, we still are only projecting manufacturing to grow this year by only 2.9, a slight increase over last year. So although we do see a recovery in credit to the manufacturing sector, I think a lot still remains to be done to get manufacturing sector to grow at a faster pace than the 3% or so that we are projecting. On the other hand, we see significant increase in credit to the trade sector, reaching 12% in July. We see an increase in credit into the building and construction sector, which has gone to 38.8% in July. And for consumer durables, in a sense reflecting confidence in the, at least in consumption, the credit for consumer durables has increased to 10.3% in July of 2025. The CEOs and the market perception surveys also revealed sustained optimism about domestic business activity and economic growth prospects for the next 12 months. For the commercial banks, we see that 90% of the banks are either very optimistic or optimistic about growth prospects for the next 12 months. With regards to the non-banks, we see about 78% of the non-bank private firms also are either very optimistic or optimistic. And finally, the CEO's survey, we see about 77% of those surveyed expect growth to be either the same or higher in the next 12 months. And this optimism was attributed to improved agricultural production, supported by the favorable weather conditions, the stable macroeconomic environment supported by low inflation and a stable exchange rate, continued decline in interest rates, and expansion of the digital economy. Nevertheless, some respondents expressed concerns about subdued consumer demand, high cost of doing business, and increased global uncertainties attributed to higher tariffs and geopolitical risks. To summarize on the domestic economic growth, the economy remained resilient in the first quarter of 2025, with real GDP growing by 4.9%, and this reflected robust performance of agriculture, a recovery in industrial activity, and in particular construction. The leading indicators of economic activity point to improved performance in the second quarter of 2025. The growth of the economy is expected to pick up both in 25 and 26, with real GDP growth projected at 5.2% and 5.4% respectively. This outlook is supported by continued resilience of key service sectors, strong momentum in growth of agriculture, and the recovery of the industrial sector, particularly the construction sector. The MPC surveys conducted in July of 2025 revealed sustained optimism about business activity and economic growth prospects for the next 12 months. And this outlook is subject to risks, including trade policy uncertainties, heightened geopolitical risk, mostly in the Middle East, and also regional conflicts. Turning to the monetary policy implementation, as you know, we have a new monetary policy implementation framework, which is based on inflation targeting, and essentially we try to do monetary policy operations to ensure that the interbank rate closely tracks the central bank rate. And as you can see from that panel, if you go back to the beginning on August 1st, 2023, you can see there was a big difference between the interbank rate and also the CBR. But over time, we have refined this framework, and you can see in July, August towards the end, that indeed the interbank rate is closely tracking the central bank rate. Following the implementation of that monetary policy, the short-term interest rates have declined further in June and July of 2025, which was in line with the policy decision to reduce the central bank rate.